While the world was sleeping, the exit door wasn't just revealed, it was slammed shut. Over 580,000 traders were deleted from the market in a single night, as the Warsh Shock triggered a violent algorithmic unwinding of leverage. This isn't just a market dip, it is a forced liquidation of every retail investor who thought the easy money era was a permanent fixture of the global economy. If you woke up this morning and felt the ground shifting beneath your feet, you aren't alone, but you are in the right place to find clarity. Welcome to Money and Power. Good morning. It's Friday, February the 6th, 2026. If you've looked at your portfolio this morning and felt that familiar hollow pit in your stomach, take a deep breath. You're in the right place. On this channel, we don't do hype, we don't do moon fantasies, and we certainly don't do panic. We do common sense. The 98% of the population is currently screaming crash across every social media platform they can find. They're watching Bitcoin lose 50% of its value from the record highs of $126,000 we saw just last October. They're watching silver trade at $74.52, a massive gut-wrenching move that breaks people who don't understand the underlying plumbing of the financial system. But if you're a member of the 2% Club, you know that prices in this environment don't just fall, they are pushed. Today I'm going to show you the invisible hand doing the pushing, the specific flaws we are watching for Bitcoin and silver, and why the entire metals complex, including gold, platinum and palladium, is signaling a massive tectonic regime change at the Federal Reserve. Let's look at the primary catalyst for this morning's carnage, the Warsh Shock. The nomination of Kevin Warsh to succeed Jerome Powell as Fed chair has sent a shockwave through the financial plumbing that many experts simply didn't see coming. For months, the market was betting on a Fed that would keep printing money, keep inflating the balloon, and keep buying bonds to cover the $38.5 trillion debt trap we discussed in depth on this channel and particularly in yesterday's video. Kevin Warsh represents the complete opposite. He is a return to sound money, a long-standing critic of oversized balance sheets, and a proponent of a smaller, more disciplined Fed. The moment his name hit the wires, the US dollar index, the DXY, didn't just rise, it weaponized. When the dollar flexes its muscles, it sucks the air out of every other asset in the room. It's a mathematical certainty. It is a synchronized liquidation across the board, and we're seeing it in real time today. Gold has been forced back to $4,853. Platinum is sitting at $2,001, and palladium is currently $1,650. These numbers aren't just digits on a screen. They represent the massive withdrawal of liquidity from the system. The big institutions aren't selling because they've suddenly lost faith in the long-term value of hard assets or digital scarcity. They are selling because they're being forced to. They need dollars to cover their losses in other sectors, to meet margin calls, and to stay solvent as the cost of capital moves higher. It is a massive margin call on the global financial system. And if you are trading on paper or using leverage, you are currently the liquidity that the big banks are using to save themselves. You need to know exactly where the support levels sit, because in a storm, you need to know where the anchor holds. So let's talk about the specific numbers for the assets we track. For Bitcoin, we saw a flash drop earlier this morning that brushed against the $60,000 mark before it clawed its way back to where we sit now at around $64,000. This $60,000 level is the psychological line in the sand. If the extreme fear currently gripping the market doesn't find significant buyers here, the next structural support is the 200-week moving average, which sits at around $58,500. If that level fails to hold the line, the ultimate flush level, the point where the last of the weak hands are finally shaken out, is the $52,000 range. That would be a painful retracement, but it is a scenario the 2% Club must be prepared for. Now let's look at silver. We're currently trading at $74.52. This is a violent correction from the triple-digit highs we've seen recently. If the dollar index continues its relentless climb towards the 106 or 107 level, we have to be prepared for a support test between $62 and $64. I know that sounds drastic, and I know it's not what people want to hear. But as the voice of reason, I have to give you the map as it is, not as we wish it to be. However, you must look at the physical premiums. In the East, particularly in the Shanghai Gold Exchange, physical silver is still trading significantly higher than these Western paper prices we're seeing on the COMEX. That tells me the physical floor is much higher than the paper floor you see on the trading apps. The disconnect between paper and physical has never been more obvious than it is this morning. The question everyone is asking is, how high can they recover? In every previous forced liquidation, whether it was the 2008 crisis or the 2020 liquidity crunch, once the forced selling ends, the rebound is often more violent than the drop. For Bitcoin, a reclaim of the $84,000 level is the first major hurdle we need to see to prove the bull market trend hasn't been permanently broken. For silver, we need to see a snapback above the $90 mark to signal that the kite string has been reattached and the panic has subsided. The reason the 98% fail time and time again is that they only look at one asset at a time through a tiny straw. They see Bitcoin drop and think, crypto is dead. They see silver drop and think, the metal story is over. But when you look at the board today and see gold at $4,853, platinum at $2,001, and palladium at $1,650, all dropping in perfect lockstep, you realize this is a liquidity crisis and not an asset crisis. The system is starving for cash to pay the interest on that $38.5 trillion debt we keep coming back to. The central banks and the big institutions are shaking the trees to see who drops their fruit. The 2% Club doesn't drop their fruit because we understand the fundamental difference between price and value. Price is what you pay today in a moment of panic. Value is what the asset represents in a world of devaluing currencies. Now, I want to take a moment here to thank those of you sharing these updates via WhatsApp and text messages. I can see in our channel analytics that dark social sharing is making up over 50% of our external traffic. That is a staggering statistic. It tells me that you're sending these videos directly to friends and family who are panicking this morning, looking for someone to tell them what is actually happening. You are becoming the voice of reason in their lives, and that is exactly why this channel exists. We're looking into launching a newsletter soon because the retention from our Gmail viewers is also high. You clearly want the depth and the detail that the mainstream media refuses to give you. So what is the plan for today? First, you must identify the levels and stay detached from the emotion. Keep your eye on $58,500 for Bitcoin and the $62 to $64 range for silver. These are the red zones where the most pain is felt by the leveraged 98%. Second, watch the US dollar index. If the DXY starts to cool off or retreat from its current highs, the precious metals and Bitcoin will be the first assets to rocket back up. Third, and most importantly, remember that in a liquidation, paper wealth can evaporate in seconds, but the physical asset in your hands or the unleveraged position you hold has no margin call. The physical metal doesn't care about a computer program in Chicago or New York. The Warsh Shock is doing exactly what it was designed to do. It is clearing the board of speculators and resetting the market for a new, harsher regime. The 98% are selling at the bottom because they are being forced to sell by their brokers, their debt, and their fear. The 2% Club stays calm because we have a plan, and we have the patience to see it through. We don't catch falling knives, we wait for the knife to hit the floor and stop vibrating before we make our move. This is how wealth is transferred, not by luck, but by staying grounded when everyone else is floating away in a sea of panic. To truly understand why the Fed is pivoting this hard and why they're willing to let the markets bleed like this, you must watch my previous video on the $38.5 trillion debt trap. It connects the dots between the Treasury, the Fed nomination, and the crash you're seeing today. Stay calm, stay physical. The videos I've mentioned are on the screen now. I am the voice of reason, and you are the 2% Club. I'll see you in the next video.